You are an NRI, you got money sitting in India, rent from a flat, dividends, proceeds from a property you just sold, money you inherited, a pension landing every month. And now you want to bring it to where you actually live. Simple, right? It's your money. Except the moment you try, you hit a wall of forms, limits, tax deductions, and bank questions nobody warned you about. So, most people do one of the three things: delay the transfer for months, pay for more tax than they actually needed to, or make a compliance mistake they never even notice. Here's what almost no one tells you. Moving your own money out of India isn't a banking problem, it's a compliance problem. In this video, I'm handing you the entire repatriation playbook, the account your money should sit in, the one limit everyone gets wrong, the tax rules, the exact forms in order, and the latest updates quietly tripping up people. By the end, you will know exactly what to do. Let's get into it. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. This is Finicky, where I simplify money the same way I practice it. If this is useful, hit the like button and then click hype right next to it. That's what gets this in front of more NRIs like you. So, the foundation. Repatriation just means moving money from your Indian account to your overseas account, converting rupees to your foreign currency along the way. Rent, dividends, property sale proceeds, pension, inherited funds, all of it. And all of it is governed by one law, the Foreign Exchange Management Act, or the FEMA. And the RBI issues regulations and circulars under it, which is why the rules keep updating even though the act itself stays put. For any NRI, FEMA compliance isn't an option, it's the law. Now, something most people get wrong. FEMA decides your NRI status differently from the Income Tax Act. And the easiest way to see is, it is the one question each law asks. FEMA asks why you left and whether you mean to stay away for long. Move to Dubai for a job with no fixed return date, FEMA treats you a non-resident from the day you fly out. It's about your reason and your intent, not a stopwatch. The 182-day figure is there just as a backstop, but your purpose is what really decides it. The Income Tax Act, something totally different. How many days were you physically in India? It's a pure day counting with thresholds running across 4, 7 and 10 years period. So the same person in the same year can be a non-resident under FEMA but a resident under Income Tax Act. That's not a glitch, they're just measuring different things. And why does this matter to you? Your bank account, your investments and your repatriation rights all run on your FEMA status. Your tax runs separately under the Income Tax Act. 2 rule books at the same time. Which brings us to the most practical question: which account should your money be in? Because that single choice decides how easily it moves. As an NRI, FEMA doesn't let you hold a regular resident savings account. You operate through one of the 3 accounts types, each with differently complete rules: NRE or non-resident or external account. For money earned outside India, your UAE salary, overseas savings, foreign income sent home, fully repatriable, principal and interest, no cap as long as the funds came from genuine foreign remittances or other permitted sources. And the interest is completely tax-free in India while your NRI status holds. Think of it as a clean in and out channel for foreign money. NRI account, non-resident ordinary account. For income earned within India, rents, dividends, pensions, property sale proceeds, inheritances, it's the account most NRIs actually deal with, and it's where the most stubborn myth in NRI finance actually refuses to die. Here's a myth that there's 1 million limit on sending your Indian income abroad. It's wrong. Your current income in an NRO account, rent, dividends, interest, pension, it's freely repatriable once you've paid tax on it. No USD 1 million cap. That cap only kicks in on capital transfer, property sale proceeds, investment redemptions, matured FDs, inherited principals, roughly 9 to 9.5 crores worth a year. So the rent you have been letting pile up in India, scared of some ceiling, there's never one to begin with at all. And one more thing on the capital cap. It doesn't carry forward. It resets every financial year and unused room is gone. So if you're liquidating large assets over time, timing matters. One tax note. NRO interest is taxable typically at 30% plus surcharge and cess. Always plan around the post-tax number. FCNR, foreign currency non-resident account. A fixed deposit held in foreign currency, be it USD, pounds, euro, Japanese yen, Australian dollars or Canadian dollars. Your money stays in dollars or pounds, so you're shielded from rupee depreciation and it's fully repatriable. Quick example, say you have $100,000 saved in the UAE and you expect the rupee to weaken. Instead of converting now, you can park it in a USD FCNR deposit. It keeps earning in dollars, stays protected, stays accessible. Easiest way to remember: NRE for foreign income coming in, NRO for Indian income staying in, FCNR for foreign currency sitting in India. If this is helping so far, please hit the subscribe button. There's a lot more NRI money stuff like this coming to you, so you don't miss it. Now, the part that trips everyone up: tax and documentation. For NRE and FCNR, no tax on interest and nothing beyond a basic FEMA declaration. NRO is different. Money flowing in it is treated as Indian income, so it's taxable. TDS depending on the nature of incomes, generally 30% plus surcharge and cess for rent, interest, dividend, etc., and often deducted before even it reaches you. But before repatriating, you still declare the income and clear the compliance. And here's where there's often a wide gap between the tax you actually owe and the tax India takes from you. A gap most NRIs never close. If you're an NRI, India is probably deducting 30% tax on your Indian interest income, and a lot of you are letting it when you actually don't have to. India has tax treaties called DTAA with over 90 countries built so the same income isn't taxed twice. Under many of them, the 30% can drop to a fraction, but here's the part people miss. You can get the lower tax rate applied at the source the moment tax is deducted, not clawed back as refund a year later. It's just not automatic. You hand your bank 2 documents before the deduction: a tax residency certificate from your country of residence and Form 10F. Submit them in time and you are taxed at the treaty rate upfront. Skip them and you pay the full 30%, then spend a year chasing the difference. Same income, same law. The only variable is whether you file 2 forms on time. This is one of the highest value moves in NRO tax management, and exactly why a CA who knows cross-border work pays for itself. Now, asset sale have their own logic in 2 clean scenarios, and this is the one most NRIs get backward. If you are an NRI selling assets in India, how much you can send abroad depends entirely on one thing: how originally did you pay for it? Bought investments via capital markets with foreign funds, foreign remittances, or money from your NRE account, you can repatriate the full sale proceeds. But if you bought it with Indian income or NRO funds or inherited it, then it falls under the USD 1 million a year capital cap. And one hard line that never changes: as an NRI, you can only buy residential and commercial properties. Agricultural land, plantation properties, and farmhouses can't be bought as an NRI. You can only inherit them. So, what's the actual paper trail? For NRE, typically a transfer request to your bank with the amount and overseas bank account is good enough. It's minimal. For NRO, more layers are involved. Form 15CA, your online self-declaration confirming taxes are paid or deducted, and Form 15CB, a CA certificate. But do note about this money saver: it's only required once your taxable remittances cross 5 lakhs in a year. Below that, you generally just file Form 15CA Part A, no CA needed. Above 5 lakhs, the 15CB is mandatory, plus Form A2, the standard FEMA declaration. Then supporting proof of source: rental agreements, sale deeds, inheritance documents, investment statements, and so on and so forth. The bank verifies it and it goes out via SWIFT. Here's a practical tip: if you need a 15CB, get your CA in early. That certificate means reviewing your whole tax position, and starting late is what causes delay. Also, do note from April 2026, Form 15CA and 15CB are now referred to as Form 145 and 146. A quick word on investing. Because a smart move is thinking about repatriation before you put money in, not after. The good news is that a lot of the popular options are repatriable. Listed Indian stocks, investments bought through portfolio investment scheme, government securities, and PSU bonds. All of these are generally that let you move both your principal and your returns back out, subject to the usual rules and taxes. But here's the principle that matters more than any single product: the source of the money decides how easily it comes back. Invest through your NRE account with foreign money, repatriation is smooth. Those funds are already free to move. Invest through your NRO account with income earned in India, still possible, but you are inside the USD 1 million capital cap with the compliance that comes with it. Real estate works the same way. Residential and commercial properties are fine. Agricultural land, plantation property, and farmhouses are the exceptions. As an NRI, you can't buy them and you can't even repatriate their sale proceeds. The one exception there is that you can still inherit them, but you can't actually purchase them. The last piece, and the one that bites hardest: Compliance. In early 2025, RBI made a move to make rupee-based cross-border transactions easier. Overseas branches opening rupee accounts, simpler investment account rules. On paper, more flexible, and in practice, banks have gotten stricter on documentation, KYC, and source of funds checks. So let's look at this. 1. Still have a resident savings account from before you became an NRI? It must be redesignated as NRE or NRO account. Running a resident account as an NRI isn't allowed, and FEMA penalties go up to 3 times the amount involved. 2. Take re-KYC seriously. Banks have been aggressive on NRI accounts, miss the notices, or your account can be frozen until you comply. Update proactively. 3. Keep source of funds proof current. Most delays aren't because the transfer is illegal, they are because the paperwork is incomplete. And if you have ever need to move more than USD 1 million from your NRO account in 1 year, that needs specific RBI approval. May be possible for genuine cases like medical emergencies or large liquidations, but it's discretionary and I have not seen any approvals as such. To bring it together, NRE for foreign income, NRO for Indian income, FCNR for foreign currency. NRE and FCNR are fully repatriable. For NRO, remember the split. Current income flows out freely after tax, things like your rent, dividend, or interest. Capital transfer hits the USD 1 million cap. Handle the tax and paperwork first. Use DTAA if it applies and file your TRC and Form 10F early so the lower rate actually hits at source. For NRO transfers above 5 lakh, keep Form 15C and CB and source proof ready. The biggest mistake is treating repatriation like a simple bank transfer. It's a regulated process. The more organized you are, the smoother it goes. If you have hit issues with NRE, NRO or repatriation yourself, drop it in the comments. It'll help others avoid the same trap. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thanks for watching and I'll see you in the next one.